This is Matt Godleski with CapTrust Advisors, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks decline led by technology shares as a pipeline shutdown adds to price pressures and inflation data soars to the highest level in 10 years. Equity markets faced a major hurdle this week as inflation data came in much higher than expectations. Consumer prices increased by the most since 2009, and some investors now fear that a 1970s-style price spiral could be in the making. Adding to concerns, a cyber attack against a major U.S. oil pipeline crippled gasoline supplies. Employment data also surprised to the downside, with Friday's jobs report missing expectations by hundreds of thousands of jobs. Risk sentiment soured, and markets saw the biggest dip since January. Investors are hyper-focused on the price increases seen in recent data, and with good reason. The Fed looks to be facing a major test in coming quarters, with inflation pressures mounting. Their current policy of zero interest rates and bond buying to support the economic rebound could need a rethink if prices get out of control. At present, the Fed appears to be taking the inflation print in stride, expressing confidence that the experience will be temporary. Several factors support their case, including inflation expectation readings, significant slack in the labor economy, and disruptive technology and globalization. That said, the Fed has made clear of their intention to act if they see price increases becoming more sustained. There is an extreme supply-demand mismatch seen globally, leading to the price movement in commodities, rents, and other goods. The economic lockdowns last year have crippled supply chains, while the unprecedented stimulus efforts have created demand not seen in decades. Both supply and demand, however, should normalize over the coming quarters, according to monetary authorities. Policymakers expect the ultimate inflation figure to come in at 2.4% for this year, and to settle to 2% for 2022. After years of missing their 2% inflation target, the Fed is willing to let the economy run hot to meet their employment objectives and bring workers in from the sidelines. Even with the pullback in equities this week, markets are still at historical highs regardless of the valuation metric used. The market is dominated by high-flying tech names that could face double-digit declines for them to return to more normal relative levels. Based on some measures, stocks are trading at valuations not seen since the tech bubble. Despite the selling pressure concentrated in tech stocks, they still trade at an over 20% premium to the rest of the market. That may leave more room for them to fall ahead, or alternatively, for the rest of the market to catch up. One consistent pillar of support for these firms, low interest rates, could quickly unravel in the months ahead. As the economy reopens, rates seem to have no direction to go but up from here. This could be a real problem because relative to bonds, stocks are already less attractive than at any time in the last decade. At present, we are looking for opportunities to add to risk assets if the sell-off continues. We have anticipated a pullback for several months and believe further declines lay ahead. Any major dip in stocks would be considered healthy to reduce froth, and we are ready to act when necessary. In particular, we are focusing on adding to companies that can more easily pass on price increases to consumers while maintaining healthy profit margins. Given inflation worries, these firms should be able to weather new cost paradigms well. As always, we continue to monitor unfolding market dynamics and act only when appropriate. Thanks for watching, and check out our website to read the full edition of The Pulse for more details.